Last night, futures opened sharply lower. It looked like it was going to get really ugly, especially after all the headlines. Obviously, we're in the green today. Nonetheless, you're out with a note talking about how you are reducing your allocation to equities right now. What is the main driver of that call?
The real catalyst is this increase in trade tensions and sort of policy uncertainty. A month ago, it looked like we were in sort of a prolonged ceasefire between the U.S. and China after the G20.
Yeah.
We get the August 1 announcement of tariffs going up. A bit of a pause, pushing some December. China responds, and then Friday afternoon we get sort of the tweet storm, and then 5 o'clock the announcement. It's kind of escalated beyond a level that we thought was reasonable, and now you're kind of risking tipping the economy. It's not a recession, but at least creeping from sort of the manufacturing trade sector into the service sector. Because of this almost extreme uncertainty, it's really hard to take a position. I think we've seen in the past, 72 hours, kind of flip-flopping back and forth between increased tariffs, dialing back, no, actually wanting to go higher. It's really hard to know what to believe at this point in time.
Here's the argument against that, right? People take a look at how low benchmark bond yields are, and they say just from an income perspective, you're earning the most to own the S&P 500, just looking at the earnings yield versus 10-year Treasury yield going back to 2016. What do you say to that argument?
So that's a valuation argument. I think it's valid, but valuation matters in 2 or 3 or 5 or 10 years. It doesn't necessarily tell you what the market's going to do over the next 3-6 months. So equities might look more attractive right now, but if we get an escalation in trade that causes economic growth to slow, earnings outlook to decline, bonds are going to outperform equities.
This is interesting. So in other words, the call that you're making is a 3 to 6 month call.
That's correct, yes.
It is not beyond that. Okay.
I mean, I think, one of the things we want to convey to our clients is this is not a end of cycle. This is a kind of a pause or kind of a risk to the cycle. We think the bull market will continue. You talk about the U.S. economy. Economic fundamentals are still pretty solid. Consumer spending is good. Service side is fine. You're seeing some kind of cracks in the armor there, but it still should be okay. If this escalates, though, and if we just look at the pattern and just kind of take it for what it is, every time the U.S. has had tariffs, China's responded. President Trump kind of responds. China does some sort of response. If you take this to logical limit, we're going to have tariffs of like 25% plus across the board. Then your chance of recession next year goes to 50-50.
So where do you dial back the most at the moment?
The most right now is kind of emerging markets. I mean, Luke have referred to, like these companies, U.S. companies that have exposure to China. So we've dialed back in emerging markets, international markets, even the U.S. as well. But right now, the U.S. still looks like it's kind of the best house in a so-so neighborhood.